Hey everybody, we are barreling through the introductory topics in managerial accounting here, and we've come to the part where we need to talk about that factory overhead account. Now, I introduced the idea of factory overhead in another video where we talked about product and manufacturing cost. We said our manufacturing cost was the sum of the direct material, direct labor, and factory overhead. And then in our job costing video, we showed you how all those costs flow through the accounting system. Now I want to focus on that factory overhead account by itself, and we're going to talk about how to handle that from an accounting standpoint. So we'll get right to it. Last time we talked about the factory overhead cost, and we said factory overhead was any cost that was required to create a product or deliver a service, but it wasn't directly related to that product or service. We had to incur it, but it wasn't directly related or tied to the product being created, the service being delivered, what have you. And so we had some examples there of these particular factory overhead items. We talked about indirect material that went into the final product, but it wasn't very expensive as far as the total cost of the product. It wasn't even worth our time to trace it individually. And so we just dump it into overhead. Same with indirect labor. We talked about factory utilities, how we had to have the electric and the power and the water and the heat in the factory. But those items, while we had to have them, it couldn't really tie them directly into any single product or job coming off the line. Same idea with the depreciation on the factory building and the equipment. All the costs indirectly related to the job. We have to have them, but they're indirectly related to any individual job. So we have to allocate that factory overhead to every job or every product. And we talked about the way we do that. We do it by coming up with a predetermined factory overhead rate. In our last video, we talked about really just an estimated factory overhead rate because we're taking the estimated total overhead cost, all of them together, the whole bucket, and then dividing it by some kind of activity base. An activity base might be the number of direct labor hours going on. It could be the number of machine hours in the factory, whatever kind of base we feel is most applicable. We talked about coming up with that predetermined factory overhead rate. In our example, we said we had $50,000 worth of overhead estimated and a base of 10,000 direct labor hours, and we just took the two and came up with a $5 per hour rate for overhead. So every time we had a direct labor hour in a job or a product, we'd slap $5 of overhead on it. So when we did that, we said, okay, if we had two different jobs, one that had 350 hours and one that had 500 hours of direct labor, we would apply the overhead to those jobs based on that $5 rate. And we went through all of that in our last video. So if you didn't quite catch it, if you skipped that video, I suggest you go back and give that a look, because today we're going to focus on how does that the factory overhead account work? How does that factory overhead account work? So I got a little T account here. Don't freak out and have nightmares about your days in financial accounting because you see a T account. And just a reminder, our T accounts always have a debit side and a credit side. One side the account's going to go up, one side the account's going to go down. For the factory overhead account, that's going to live on the asset side of the accounting equation. And we're going to use it to hold information for one period, our overhead information for one period, and then we're going to close it out at the end of the period. So it's a little bit weird. In financial accounting, I brainwashed you all to believe that the only time we ever closed out accounts was if they were revenue or expense accounts. And that's true for the most part. But this is an account that lives on the asset side, but it's not designed to carry any kind of balance. It's just kind of a temporary holding bucket, okay, for our overhead. Our two sides of the account, we're not really thinking about going up and going down. On one side of the account are allocated or estimated overhead is going to go on the credit side. So when we put our overhead and estimate or allocate our overhead to our jobs, it's going to go in as a credit to factory overhead. Then when we record the actual overhead, it goes on the debit side. So you got to remember, you can use my graphic here, make a note, but you might want to refer back to this. The factory overhead account has two sides, debit and credit. On the credit side, allocated or estimated overhead. On the debit side, the actual overhead that really happened. Estimated, actual. Okay? So here's how the two sides work together. Let's say in our example, we decided to allocate overhead based on that direct labor driver, and we calculated the amounts of direct labor hours and multiplied it out, and we got 4,250. We're going to apply that or allocate that to the jobs. It's going to go in factory overhead on the credit side. The other side of that entry is a debit to work in process. We're putting that overhead into play and adding it to our product cost. Okay, there's my debit, there's my credit. So we've allocated. That's not the actual overhead, that is our estimate, right? We estimated that overhead based on an estimated total and an estimated driver total. So that's an estimate. Our estimate's going on the credit side of factory overhead, and we're dumping the debit into work in process to include that into our product cost. Okay, that's where the whole process begins. I mentioned that we end up having to close that account. If our estimates are good, our allocated overhead in that credit part of the account will be pretty close to what's on the debit side and actual. It'll be close, but very rarely is it going to be exactly the same. Okay, so what happens is that's going to create a balance overall in that factory overhead account. Let me show you what I'm talking about. Let's assume that the actual overhead for the period was $5,000. We guesstimated $4,250 and put it on the credit side of factory overhead and added it to work in process. The bills have come in, the utility bill came in, the tax bill came in, all the supervisor's salary, the depreciation entry from accounting, all the overhead stuff has come in now. And we realized that factory overhead actually ended up being $5,000. So we have a $750 debit balance in that factory overhead account. We've underapplied overhead. Uh-oh. We said overhead was probably going to be $4,250. That was our estimate that we allocated to the jobs. Oh crap, overhead was actually $5,000. We underapplied. We didn't put enough overhead to the jobs when we were making our estimate. So what happens to that $750 balance? We got to close it out. We close it out to cost of goods sold and basically add it in that way. And so we would credit factory overhead for $750 and we debit cost of goods sold $750. That would wipe out the factory overhead and close it out, and that difference would show up as an addition to cost of goods sold, thereby raising the cost of the product. We're raising the cost of the product because we didn't apply enough overhead to it. Easy as that. What about the other direction? Let's say the actual overhead for the period was $3,250. There's my actual amount. There's my estimated amount. Oh crap, we've overapplied overhead. We put too much overhead to the jobs. We estimated $4,250, put that to the jobs into work in process and allocated it. But in reality, when the bills all came in and the information from accounting came in, we only had $3,250 in overhead in reality. So now I've got $1,000 overage on the credit side of that account. I've got to get rid of it. How do I get rid of it? I close it out to cost of goods sold. In this example, I would debit factory overhead. I'm doing the opposite here. And I would credit cost of goods sold. What that does is it's going to lower my cost of goods sold. Okay, it's going to make it lower for the fact that originally I put too much overhead expense to it. So now I need to bring it back a little bit for that difference between the actual overhead and what I allocated. So we can have underapplied overhead, we can have overapplied overhead. Either way, we can't leave that balance in there. We got to get rid of it. We get rid of it by flushing it through cost of goods sold. If you take a cost accounting class as an accounting major in second year, you'll find out that if it's a really, really big balance, we have to allocate it between inventory accounts and cost of goods sold, and there's a little bit more to it. But if it's a smaller difference, we flush it right out through cost of goods sold. The takeaways, what you should know: how to determine over and underapplied factory overhead, and how to close out that factory overhead balance. You'll have a few homework problems where you will have to do that. You'll also have homework problems where you have to calculate that predetermined overhead rate, and you have to use it to allocate overhead to a job. So hopefully you'll be able to handle that. Again, you'll have check your works at the end of your problem there at the bottom, where you can click on that and check your work as you go along. If you're struggling with getting things correct and you have questions, I'd be happy to help. Feel free to reach out to me. And that'll wrap it up for the videos on our chapter right here. Our next chapter we'll jump into in the following week. So we'll see you there.